This is TreppWire Week in Review for week ending July 16th. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate and CLO markets. As always, I'm with our experts Manus Clancy, Senior Managing Director, and Joe McBride, Head of CRE Finance, where we break down the news. This week, the economic data offers signs of a tepid recovery. Initial jobless claims came in at 1.3 million, just slightly lower than last week. Manufacturing indices are giving us signs of improvement. Retail sales were up in June. The summary of big banks' Q2 earnings showed that banks are on solid footing for now, but there are a lot of uncertainties. With rising COVID cases in the South and West, states are mandating face coverings and some are putting back to school on pause. And in parallel, the news that vaccines and early trials are showing promise gave Wall Street a reason to rally before pushing lower. To quote Citi's Chairman Corbett, "We're flying blind," but Manus, it does seem that the economy is inching in the right direction.
It certainly felt that way this week. It felt this way on two pivots. As you mentioned, it did feel this way on the vaccine front. From Moderna, we heard their early trial of 45 individuals that were given their first version of a vaccine, all created antibodies, so 45 for 45. The market really cheered that. It was a very optimistic headline that we saw. It will lead into another round of tests with a bigger set of candidates, and that should be in the fourth quarter. So I think that was something really to cheer. We saw that Pfizer had its vaccine put on the fast track status to kind of accelerate its development and its approval. So those are great, signs for people to kind of cling to that, maybe by the end of the year, we'll have a better indication of where we are with COVID and a vaccine and so forth. On the economic side, it's been this way for about 6 weeks. We just keep beating what are low expectations for economic data and earnings and so forth. And that too gives a sense of confidence. So you mentioned retail sales. It easily beat its consensus estimates in data released on Thursday. The 30-year mortgage is now under 3% for the first time in history, giving people a lot of opportunity to refinance and lower their mortgage costs. The Empire State Manufacturing Survey beat handily on Wednesday, another positive sign for the market. Smith Travel came out with some hotel data, which showed that in April, they were seeing about 23% occupancy. For the 30 days ending July 4th, that market was up to 44%. So 44% is nowhere near the 73% that they were in 2019, but it does show progress. And I think if the economy can continue on this trajectory and the vaccines continue to do that, we could sidestep some of the negative predictions that some were calling for in April.
Have you seen or have you read about the Moderna vaccine at all?
I have read that there were some side effects with it.
Oh, really? I think I just saw a headline like that there were some side effects, but it would be one of the first vaccines of its kind, right? Because it's not like here we go with the epidemiological podcast again, but it's not a strand of the virus that they're giving you to make you produce the antibodies. It's actually they're editing genetic code that then goes in and it edits your RNA or something, ribonucleic acid for all you biologists out there. And then it makes your body produce the antibodies naturally. It's wild, right? It's just, if they can pull this off, I think there's going to be potentially a whole new world of medicine and all that other stuff. So anyway, I went deep one day reading all about Moderna. Get it? RNA at the end.
Your riff reminds me of an old E-Trade commercial where they were showing people how easy it was to trade. And they show a woman watching a commercial for a new drug that's come out. And in the disclaimer at the end, it says, could lead to a condition known as hot dog fingers. And you see the woman pushing the button which says sell. And for some reason, I just thought that Moderna rant and knowing your background in science or lack thereof just made me think that it was time to roll out the hot dog fingers rant.
Well, I know as much as everybody who's buying the stock, right? On Moderna, on Tesla, on Pfizer, on everything, all the so-called millennials who are, day trading their stimulus checks away.
I'm not one to not have experimented on my own body in the past. When I was younger, I once gargled with Prel, thinking it was Scope.
Prel? Okay. What is Prel?
It's like an old-time shampoo.
It's
like the Scope.
Shampoo. It's old-timey. Okay.
And I was trying to run out. Anyway.
Let's come back to...
Martha does not want us to digress today.
Let's come back to what we're here to talk about. We're only at mid-month, but indications are that the delinquency rate is improving. What's behind that?
Well, there's a bunch of things, and some of it was kind of flagged in a way by CREFC and by servicers and special servicers when they redid their standards back in April to deal with forborne loans that were granted forbearances. For those that haven't been listening to the podcast or not knowledgeable about the inside baseball about what's going on in the CMBS market, about $50 to $70 billion worth of loans in the market, the borrowers for those loans have requested forbearances, which would allow them to either tap reserves to keep the loan current or to get a timeout for their P&I payments. Usually it's tapping reserves. If they do that, even though they haven't written a check, that loan will show up as current if they've tapped the reserves. So what you're seeing this month is we've seen a couple of big loans for which the paid to date remains in April. So theoretically, this loan should be showing up as 60 days late now on the basis of the last time that the borrower wrote a check. But because of the forbearance, the loan now shows up as current. So this is putting some downward pressure on the delinquency rate. And it is possible that we will see the delinquency rate either level off this month or even trend downwards because of these events. So the two loans that I'm talking about, one was the $600 million Atrium Hotel portfolio. It went from 30 days late last month to current as a function of its forbearance, yet its paid to date is still April. Another one is the $600 million Queens Center Mall in New York in the borough of Queens. Again, it had been 30 days delinquent, now current, but again, the paid through date was April 2020. So we're going to try to put out a statistic at the end of the month with our delinquency report, which shows loans that were kind of implied delinquent, which would be loans for which the servicer status shows up as current, but for which a paid to date indicates that there hasn't been a check written in some time. So we'll see what that number is towards the end of the month.
We have to come up with a good name for that indicator. It's like the paid through rate or some, I'm never good at coming up with names right away, but we'll come up with something flashy. I did just pull up some of, I have a dashboard here with some of the most recent statistics on the deals being rolled. And my universe that I look at is slightly different than the universe we use for the delinquency report, but it's still reasonable. And it's a little bit higher than it was yesterday. So we had some deals roll over the last day or two that I think are bringing the rate back up to near where it was last month, but we still have probably 2/3 or a little bit less of the universe to roll for the month.
Yeah, for those listening, we're taping this on July 16th. So today and tomorrow are heavy roll days. So next week, we should be coming back to you with close to complete numbers on these fronts for you to know.
So another thing that popped along my timeline that I was reading was CoreLogic came out with their basically their version of their delinquency report for single family. They apparently report on a lag though. Probably takes longer for them to collect the data. So in April, they saw, I think, upwards of 3.5% of all loans actually transition from current to 30 days delinquent. And that's the highest it's been in, I think it was something like since 2008. Also, a couple of things that I thought were interesting. Looking at by state, the delinquency rate is highest in New York, Louisiana, New Jersey, Mississippi, Connecticut. It's kind of like going back and forth there. New York, Louisiana, New Jersey, Mississippi. Those were, New York is near 10%. So it was unclear to me whether those included forbearances in Freddie and Fannie single family mortgages, because I think those are not supposed to be considered delinquent. And it's the same concept, right, with the paid through date versus the delinquency status. I think based on a footnote that I saw that they do include the forbearances. So the numbers are probably officially a little bit lower than what we saw there. But anyway, that's April. So it's May, June, July. We've seen states reopen. We've seen some people get back to work. I doubt the New York numbers much better, but I would assume that some of the southern states numbers are trending better.
Well, Martha talked about CEOs at banks flying blind earlier today. And another lack of radar, if you will, right now is the expiring extra unemployment benefits. So, all of these numbers with the delinquencies were done with people who are unemployed getting that extra $600 a week. Yeah. Now with this slated to end, right, this could be a floor, right? In some ways, this could be true of CMBS too later in the year, because a lot of these forbearances cover the months of April, May, and June, or June, July, and August. So towards the end of the summer, you could see some of these guys that got relief early in the cycle start to flip back to delinquent. So a lot of opaqueness for people trying to get their head around either residential or commercial data.
I think it's opacity, but we'll let that one slide. It's better than irregardless,
yeah,
or malapropism. I think that, but what you're saying kind of aligns with what most of the people that we speak to, banks, other lenders, are saying. If there's going to be distress, it's going to be Q4 2020 when, all of these programs run out and, what is it called? Your chickens come to roost.
Expire.
Or you harvest, you reap what you sow, or what else? Anything else? Irregardless,
I'm going back to little words now that I've been called out on opacity.
Well, that's a word we use very often in our life, the opaque nature of the CMBS asset class. So I think I've looked it up in the past.
Well, we'll give you another opportunity to use some big words, Manus. We had a number of TreppWire headlines and some trading alerts this week, if you want to run through some of those.
Sure. So on the positive side, to stick with that narrative of the delinquency rate falling, the $430 million loan on the Destiny Mall in Syracuse, New York, a 2 million square foot mall, upstate New York, it was extended. So that loan was delinquent last month. It had a maturity date of June 2020. That maturity date has now been extended. So the loan flips back to current now. So that was a positive story. Special servicers don't usually grant extensions for properties they don't think are going to make it. So this is kind of a vote of confidence for the Destiny Mall in Syracuse, New York. Good for them. Another story we covered, the $64 million Summit Rancho Bernardo loan, a 200,000 square foot office in San Diego. A couple of years ago, we wrote about in TreppWire the fact that Nokia had terminated its lease, leaving the borrower with an empty building, but a $13 million termination fee. But the building was vacant. As we said, it backed a $64 million loan. This month, Apple signed a lease for the entire building. So that loan should come off anybody's list of concerns at this point. On the negative side, we have another thing for which pronunciation may be necessary. The $87 million Queen Kahumana loan in Hawaii.
Is it on the Big Island?
It is on the island of Kahulu. The borrower is no longer interested in funding operating and debt service shortfalls. The collateral for that $87 million loan is 570,000 square feet of retail space, 30 days delinquent as of July, and that loan is part of CMBX 8. We did talk about a $112 million loan on an office in Woodland Hills, California. The office once housed Anthem Health with 450,000 square feet. The property was valued at $150 million 13 years ago. Anthem left in December, and this month the value was lowered to just $39 million. So it's a $112 million loan backed by $39 million worth of collateral at this point. So that's a troublesome story there.
So let me just jump in, Manus. I don't want to toot our own horn, but I'll toot a little bit. It's amazing to me how many of these types of stories we write where a loan is going to special servicing, or it's the borrowers handing in the keys, or whatever it may be. It's resolving with a loss, or there's a large appraisal reduction. It's amazing to me how many you write where you say, 2 years ago in TreppWire, we mentioned blah, 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 large tenant leaving, a large tenant downsizing, cracks in the foundation, or whatever it may be. So, it's just a little bit of a plug for TreppWire that the team is always amazes me at, where they can find this information to be ahead of the curve, basically.
Well, thank you, Joe, for the plug. And we do enjoy turning these over. We're always looking for landmines and trying to keep our clients from losing money. The other things that came to light this morning, the Mall of America loan flipped to 90 days delinquent. So another payment missed for that huge loan on the Minnesota Mall of America loan. We saw a 2014 mixed use development loan, a $23 million asset wiped out with 100% loss. You don't usually see that with loans made in 2014. And the former Barney's flagship store at 660 Madison Avenue, the borrower behind that is looking for an 18-month extension. Barney's filed for bankruptcy about a year ago, bought by Authentic Brands. The building is mostly vacant right now, and the borrower looking to get an extension on their $76 million loan.
So there was one that you mentioned a lot there. There was one that you didn't mention, which I saw in TreppWire this week, which is that sur la table. How do you say that, Martha? Do you know?
Sur la table.
Sur la table. Under the table, filed for bankruptcy, and they're going to shutter almost half of their stores. First it was Au Bon Pomme. Now it's sur la table. I don't know what's next. Grey Poupon? La Panque de Dion? What else? But when I was reading that, as you can tell, the quarantine's getting to my head. It's almost wild to think that there was a time when a company like Sur la Table thought it was a good idea to open 250 stores, right? And it probably was when they were building out their footprint, right? Because that was before Amazon really took hold, and it was before people were buying literally everything online. But just, it's kind of one of those hindsight is 2020 things with a lot of these retailers that, it's amazing to think that at one point it made sense to open this many brick and mortar stores. And there's only so many cooking classes that you can have, and I don't know how profitable those are.
So we are going to be publishing a CMBX research piece this week as part of our series CMBX 10. And is there anything that you want to highlight about that, Manus, of what we would look for there?
Well, for those who don't get our blogs, you should sign up because we do put these out frequently. Every week we've been following a different CMBX series to point out where its exposure lies. This particular one, CMBX 10, has the combined, for those looking to short, it has a combination of high exposure to both hotel and retail in aggregate, but a much lower carrying cost than CMBX 6 or 7. So if you're looking for a short opportunity that may be a little bit less trafficked, and maybe a little bit cheaper, this would be one for you to look at. Certainly the CMBX 6 BBB minus has been very pricey. On that front, we did see a piece of news this week that one of the longs of that, one of the fabled longs, Putnam, had either ended or reduced their position, their long position on CMBX 6 BBB minus this week. So
I think it was just reduced.
So if I remember the article, they said that they had been suffering from outflows and it was a prudent time to, pare back that exposure. But as they said in commenting on this, that nobody really saw COVID-19 coming, and the trade may have worked out for them had we not seen this life-altering virus over the last 4 months.
And it may have worked out for them had they not had outflows, right? Because the CMBX longs don't have to, they have to put up margin if they're leveraging these trades. So if the value of their long position goes down, they have to put up more cash. So there's that aspect. But if it wasn't I'm sure it was, right? But if it's not leveraged, the only time as a long that you have to do anything is if a loss occurs, right? And that's when you have to make a make whole payment to the short. And I think their thesis was that these the underlying collateral in CMBX 6 will take longer than the shorts expect to take losses, and that the losses will be lower than the shorts expect. And I think there was actually, it was almost like a parting word at the end of that article that Esther Fung wrote, that Putnam still believed in the thesis. They still believe that the risk is overpriced, I guess you could say. And that the people, the hedge funds and kind of the fast money that are short the index don't necessarily have the cash or the stomach to continue to pay these premiums month after month after month, waiting to get a return. Right. Now, obviously, if you bought some like MP did, if you bought some in February and then sold out in March, you made a killing. But, going from now until when these loans actually mature, which is in the next year and a half to 2 years, it's really more like half a year to year and a half. You're going to have to continue to make those payments to be able to reap the rewards in the end, if there are any.
We're looking at retail. So as we talked earlier, in June, retail sales did bump up slightly. And in an effort to boost confidence and safety, a growing number of retailers, with the backing of their trade organization, National Retail Federation, are requiring more and more shoppers to wear masks at their stores. Is that going to bring people back?
Well, I hope so. It's, I really hope that people continue to use the mask. I've said before on these podcasts that I think that news reports have focused on those people that don't, but I do think that the people that choose not to are the vast minority in this country. I think people are trying to do the right thing. I do believe that there are many that hold dear to the "don't tread on me" tradition in the U.S. as a sign of patriotism. Normally, I kind of agree with the "don't tread on me," defending freedom and, libertarianism and do your own thing. But I do think that with wearing the mask, the patriotic move is wearing one. And here's why. The U.S. can only be at its best if its economy is fully functioning. It only fully functions if everybody starts participating again. Everybody goes to the malls, everybody goes to dinner. When the movie theater is open, people are attending. That can't happen if part of the population is frightened, right? That people don't have masks. So wear the mask. If for no other reason, it's going to help the economy get back faster. It's the patriotic move.
Now that's the best let's say, disease or non-epidemiological argument for wearing a mask so far. There's the obvious argument, which is then it reduces your risk of getting sick and reduces the risk of you spreading it.
Hey, let's not beat around the bush. The mask is horrible. It looks bad. You're sweating it, right? It's uncomfortable.
Can't wear
After about 20 minutes, it smells. But if it makes people more comfortable and it helps our restaurateurs and the people that run our delis and other things, do it. right?
So,
A better
so
economy is better for everybody.
my wife plays in a golf league, and she's, the youngest person by about 50 years. And one of the women that she plays with is a nurse. And in her spare time, she's been knitting masks, out of cloth. So I got one, and it's blue and it's soft and it's washable. And I highly recommend, because if you wear those like crappy papery ones they smell and they hurt your nose and everything else.
My favorite mask story this week was of the 18-year-olds in Manhattan that were using the mask as a vehicle to dress up as elderly people so they could sneak into alcohol shops and buy alcohol as minors. That was incredibly ingenious.
That's
I mean, if
innovation.
there's anything that's, a check mark in the positive of the Zoomer generation, it's that, ingenuity right there.
I think
We used to just
I think
find the
you've just
shadiest
coined-
places we could find.
You've just coined a term, the Zoomer generation.
No, that's not me. They've come up with that. Someone said that.
I haven't read it yet.
someplace.
So we talked about back to school. Do we think the back to school season, which is usually a healthy retail shopping season, is that going to come back or no?
It's a real challenge right now. And, you're seeing three different categories of schools. In California, they've already said in their state school systems that they're not opening. Harvard did the same thing. In other places, they said that they are opening, and they've taken the steps to do so. And then you have this vast number of schools that are still trying to figure it out. And it's getting late in the game. I mean, we're really only about 3 weeks away from that point in time when kids have to go back. So I think it's really hard to say what happens. And for us, it's hard to handicap what happens to student housing. Right, we've already put out a research piece a couple of weeks ago for all those student housing loans in the private market near California state schools. But for any other place where it's still up in the air and you have no idea whether you're going to see zero come back, 70%, 90%, it's really hard to handicap how those loans perform next year.
I think if schools don't reopen, it is a huge negative for the economy. Right. It's kind of one of those tells. It was like when we were talking about Disney World reopening, like that'll be a step in the right direction. This is 10 times bigger than 20 times, 100 times bigger than that. Right. Because if schools in major cities and elsewhere don't open, there is a ripple effect of people who then can't go to work, or people who then have to find childcare, people who have to stay home and homeschool their kids, kids that fall behind because, learning on Zoom is just not the same. All those types of things. So I really, really hope that we are in a position to go back in a safe way. I saw an amazing editorial in the Wall Street Journal by a law professor from Georgetown, and he's an older guy. And he said, I'm technically in one of the high risk categories, but it is my duty to the students to be there for them, to teach them. I am willing to take this, let's say, calculated risk, you might say, to go back. I will be wearing a mask. I'll be wearing a shield. I'll be behind the podium. Everything will be as safe as it can possibly be. But it's not fair to these kids who have already missed 6 months or a semester of school to have them miss another one. I mean, this is 1/3 of their law school education. So I really loved what he was talking about. And he went back and he talked about his father dealing with, polio and other things that were just facts of life back in the day. Right. And I think, the whole point of his spiel was we can't live trying to eliminate all risk, right? We have to live with the risks that exist in the world and do our best to, mitigate them, but we have to move on with our lives.
Initially, the office market was not one that felt the brunt of the pandemic shutdown, but we're seeing a shift in trends in this space. What are some of those that we're seeing, Joe?
Yeah, so a couple of headlines, or one headline that I saw, which is that Chicago office is seeing the highest vacancy rates it's seen since 2011. I think that was Albie Galoon who wrote that, but I'm not exactly sure, so I apologize if it wasn't. Albie's a good friend of Trepp. But what also came out this week was Newmark's quarterly Manhattan office, report. And a couple of the headlines were that the net absorption in Manhattan in office space, which basically means how much space was occupied, right, by corporations or whoever else that's occupying office space, minus how much space was vacated, right? So the absorption or the net absorption for the quarter was around negative 2 million square feet, negative 2.16 million. And that means that essentially after this quarter, 2 million more square feet of office space is now empty than was before. A couple of the other kind of highlights here, the market remained largely frozen with early signs of impact apparent in leasing activity, sublease availability, and concessions. Leasing velocity fell just above 3 million square feet, the lowest quarterly activity in more than a decade. So we were saying this, weeks and weeks ago that, no one's going to be out showing office space and no corporation's going to be looking to take space unless it's like Facebook or TikTok, which they actually mentioned in the report. So now we're actually seeing the reports and the data to kind of show that that's true. I thought one other interesting stat in there was that co-working and flex office providers gave back 400,000 square feet to landlords, mostly in Midtown South. So, again, obviously, right, these smaller spaces that are where you're packed in tight with strangers, those are probably not going to be doing too well. Obviously, WeWork has been struggling for a long time, even before COVID. So again, it's not so great to see, right? But it's also, it's good to see the actual data as opposed to kind of speculating at this point. So I think it's going to be a long time until people are back in full force in, white collar jobs in Midtown Manhattan or Manhattan in general. It's kind of my feeling.
Well, the irony is the people that have been driving huge absorption across the US, the FANG stocks, right? Facebook, Amazon, Alphabet, Netflix, and Google are those probably best suited for not having offices, right? Younger staff, nimble, ability to work anywhere, right? Whereas kind of a stagio law firm where you're used to signing documents in person and so forth. So it's kind of idiosyncratic in a way, if you will, that the guys that you're expecting to continue to drive occupancy, maybe the first ones who adopt a new system and disappear as fast as they came in.
Right. And they are the ones that are currently taking a ton of space, right? But they're also, they can very easily shift gears if they wanted to. I mean, Twitter was talking about that a while ago.
So let's turn to banks. The top 4 banks, as we talked about earlier, reported their quarterly earnings this week, and we're going to be publishing a summary of those takeaways. Give us a quick overview of what the results look like.
Well, I think you hit the nail on the head, Martha, at our open, which is nobody really knows, right? One of the CEOs said that, I think it was JP Morgan, that we could still be seeing double-digit unemployment a year from now. Jamie Dimon said, more reserves could be needed in addition to those that we have set aside. Just to put those in perspective, another $33 billion were set aside by the top 4 banks this week alone. So Bank of America, Citi, Wells Fargo, JP Morgan, another $33 billion, which takes their net reserve contributions over the last couple of months, I believe over 100 billion, which is just extraordinary. And what that tells me is that they really have no idea how this turns out. And how would they, right? We've never seen anything like this in decades. We don't know if there'll be another stimulus package. We don't know if there'll be a vaccine. And I think that investors saw the size of these reserves being set aside, even for banks where they beat on the top line because of positive trading, revenue influences, or other things, still sold off the stock. So after its earnings, B of A was down 3%, Citi down 4%, Wells down 5%. They, in addition, cut their dividend. JP Morgan was up slightly, but they really had a good quarter, especially on the trading front, and they weren't rewarded for that because I think people just have no idea where this goes.
I think it was the reversal of trends we've seen for the last 5 or 6 years. We've seen banks move away from trading and investment banking and try to, or at least invested more on the consumer and the corporate lending and the asset management side. And those banks have been rewarded nicely. Morgan Stanley, right? Bank of America, JP Morgan. But who did well this quarter? Goldman Sachs, right? Because they don't have much, they have very little consumer exposure other than in Marcus, which I actually think is a pretty good bank. I have some money in Marcus, so I want it to do well. Morgan Stanley did fairly well, and they're very much, wealth management, asset management, not so much on the lending side. So again, it's the guys that are not too exposed, lending to corporations and individuals, whereas Bank of America, Wells Fargo are huge in the single family mortgage space, were much more negative.
Well, under the category of necessity is the mother of invention, we've seen graduations on football fields, recitals and concerts in parking lots, and pivots like Hanes Brands, the maker of underwear, making face coverings and medical gowns. Any noteworthy pivots from your point of view?
Well, we were talking before about back to school. This is a negative pivot. The negative pivot I have a nephew that goes to Holy Cross, and he found out today that the only food service they have on campus will be deliverable by Grubhub, meaning school cafeteria food delivered by Grubhub. Now, if you're going to go to the effort of getting Grubhub, who's getting school cafeteria food? Like, who thought this was a good idea? That's my bad pivot of the week.
Well, you're not realizing, Manus, that when you went to school, it was, if you don't eat your meat, you don't get any pudding. But now it's like 4-star restaurant type food at all these very high priced colleges, right? Well, speaking of pivoting, I saw one of my favorite headlines so far is out of Israel in the New York Post, can't embrace friends and family these days, hug a tree instead. So that is the message that Israel's Nature and Parks Authority is spreading on social media to try and help people overcome the sense of detachment that coronavirus social distancing rules can bring. So for those arbor philiacs out there, it's your time.
We'll leave you with that green message. With that, we'll close. Thanks to our producer, Keegan St. Ange. Join us next week as we look at what's happened during the week and how it may have impacted you. If you have a question, send us an email at podcast@trepp.com. Until then, visit trepp.com for more info and subscribe to the podcast with your favorite app. Thank you for listening and stay well.
All right.